Welcome to the capacity release forecast for this coming winter. It's Greg and I. Greg's president of Skip Houston and Capacity Center. Most of the data, in fact, all the data you're going to find in today's webinar comes out of our Capacity Center database. We'll get into what that all is in a minute. So with that, let me start with the forecast for this winter capacity release market. So I kind of thought it was humorous to take a look at temperature because that's obviously a lot to do with this winter. So this is what the government thinks. They think it's going to be above average in the east northeast, which is usually where the capacity constraints are, and above average out west. And it only gets cold up in the northwest. That's what the government thinks. Then the famous Farmer's Almanac, they think completely the opposite. So so I just shared that because you can look at weather as much as you want. Your opinion is as good as anybody's. We're not weather experts. But with that, let me get into what the bellwether is. I'll turn this a bit over to Greg. He's really the capacity expert. Greg?
Sure. So looking back in October of 2021, there were 114 pipelines and storage companies that had capacity trading deals in October for the month of October, November, through the winter and whatnot. In October of 2022, only 76 pipelines had storage, and pipeline storage companies had deals. October 2021 had 10,692 deals, and October 2022 had 10,168 deals. That's a 5% reduction in deal count. The 38 pipelines that had no October 2022 deals accounted for only 46 deals in 2021. They're sparsely traded pipelines. But even though there are fewer deals this year, the total traded capacity in October was greater. What you see here is October 2021 on the left and 22 on the right. The total days of traded capacity, that's meaning in each, if you sum the days traded for the duration of each deal, there were 2.2 million days traded in October 2021, 1.9 million in 22. Greater than 1 year deals, you see the deal counts, more greater than 1 year deals in 21, more greater deals throughout. What's very interesting here is that the distribution of the deals was largely the same. And the percent of winter deals, meaning and you see this, the second gray bar down, the count of winter deals went down, but the percentage of winter deals in the distribution was the same. A winter deal is for 151 days, and the year-long deals are for 365. Next slide, please. So what does all this mean? Our peak spot capacity prices in the Northeast will be higher than in 21-22. The reason we think that's to be the case is the Northeast is ever more constrained, and electric generation throughout the Northeast calls on capacity. And when that happens, coincident with residential and commercial demand, that pops up the capacity prices in addition to the actual gas price. The average spot capacity prices in the Northeast and New England will be the same or lower. A spot deal is for a day or the weekend, and the reason they'll be the same or lower than in 21-22 is because the weekend deals and the spot deals are likely to occur when the capacity market is less constrained because people aren't using the capacity, and therefore the prices will be largely the same in those spot deals as they were last year. A few capacity traders will control a majority of the available winter capacity. The domination of the large players throughout the market is increasing, meaning fewer players carrying more capacity. With respect to weather, if the government is correct, warmer weather, there'll be more spot winter deals done because residential commercial demand will be less, and the ability of the LDCs to let go of capacity to monetize some of that capacity will be greater. And notably, very little capacity will be traded on southbound paths. With the exports of LNG continuing and running apace to serve the Asian and European markets, and the fact that in the colder weather, the LNG terminals run at a higher capacity factor. That gas is coming from the north, northeast, down to the south, and those paths will be full. And because they'll be full of that demand, there's not going to be capacity release on southbound paths. So now let's look at 2021 and 2022, where deals are being done above max rates. Now, what's interesting is that the daily equivalent of year-long deals at above max rates has increased in the quantity by about 20%. Daily equivalent was 800,000 a day in 21 and about a BCF in 22. A daily equivalent of a year-long deal is basically how much is the day over that year. So it's a BCF a day of deals done at above max rates this year. The winter deals went down in quantity and in volume, but the year-long deals went up in quantity, if not in volume. The other thing that's interesting is that the percent of total above max rate deals that were year-long in 21 was 63%, and in 2020 for the coming year, this 22 year, it's 83%. That means of the above max rate deals, 83% were for a year-long period of time. What does that mean? When we looked into it, we found that a lot of those deals were for retail choice areas and retail choice markets. That means that next spring and summer, those same above max rate deals, to the extent people have traded quantity greater than demand, summer demand, they're going to be looking to unload that. And those parties will be sellers. They'll be opportunistic for buyers in this market as well. So let me give you a little more insight into these max rate deals, the pipes it's happening on, and why I think that's the case. So the Northeast pipes, where there's retail choice, as I discussed a moment ago, the triple T's, Tennessee, Texas Eastern, and Algonquin, and the Old Dominion Eastern Gas, markets serving New York and New England primarily, where there's a lot of retail choice. That's where we're seeing a lot of the high numbers and the high quantities of trades. That means, as I discussed earlier, that in the off season, there'll be likely sellers who are sitting on above max rate contracts and will want to monetize them to the extent they don't have market to use that capacity. But what's interesting, I also found in looking at on the pipes that had the above max rate deals, Texas Eastern gas originating in Zone 2, Tennessee gas originating in Zone 4, and gas delivered to both Zone 4 and Zone 5. So having capacity in those in Tennessee, both to receive and deliver in Zone 4 and receive in 4 and deliver in 5 are among the high quantities of above max rate deals traded. Other pipeline in the Northeast is Millennium. Same thing, access to low-cost supply, access to higher valued market, in particular Algonquin, has caused Millennium to be a pipeline in which there are a lot of above market rate, above max rate deals. Sorry. Another interesting pipeline and a market area is Columbia Gas Transmission to the Southeast Virginia market. There's year over year, that market, there's more capacity above max rate capacity traded into the Southeast Virginia market on Columbia Gas Transmission, and also to the Washington area market, Baltimore and Washington. And so that's driven by the delta between the supply price at the pool and the market price, whether it be in southeastern Virginia or Maryland and Washington area. That would make sense. And that's where we're seeing above max rate deals.
So
So-
let me ask a couple of questions on max rates for those that are not familiar with that.
Sure.
So is this a situation where somebody bids for capacity and bids above the actual tariff, the pipeline charges?
Yes, so several years ago, the FERC took the cap off of capacity release for deals of 365 days or less. And that gave the ability of sellers to get above max rate for the capacity and buyers to acquire capacity that they valued that would otherwise not be available to them because they couldn't pay the market price for it. And so let's say the max rate is 50 cents per decatherm per day, and the value, the delta between supply and market is 75 cents. You might see somebody bid 65 cents for the capacity because they can get access to it and still sell the gas through that capacity at a profit. So the max rate is what's set by the FERC. It's a regulatory max rate, but in the capacity market, there is no max rate. It's a market price for deals of a year or less. And so I've kept an eye on those deals to see both where potential capacity could be called for expansions, because if you're seeing above max rate deals, that means that capacity is constrained, or market there's more market demand than there's capacity, or there's more supply than there is takeaway. So what causes the value of capacity to exceed max rate is when there's either or both of more supply than takeaway or more market than delivery capacity.
So it looks to me, looking at these numbers, about a third of this is for long-term deals, like 1 year or whatever.
Yeah. Yep.
So when you say you're going to be sellers, obviously you don't need that capacity in the shoulder months, spring and fall. Is that?
Yeah. So I'm sorry, go ahead. I apologize.
No, is that pretty much what you're seeing?
Yeah, so to the extent the buyers above max rate bought capacity to serve peak or near peak demand markets, when those markets erode through weather erosion, weather is no longer present, they're going to be holding capacity that they no longer have market for and are going to want to monetize that capacity. The reason that could be the case is because a lot of times when the LDCs are selling under retail choice, they're making you buy the max quantity that your market demands, and you're buying it for a whole year. And so you don't need it all year, and you're going to need to be selling it when you don't need it. And therefore, a buyer that could be a potential opportunity for a buyer to buy it at a then current market rate from a motivated seller.
So what kind of discount in those spring fall to max rate are you kind of seeing as a percentage, like more than half? Or
so depending on the market you're serving, if you're going to Chicago, say, you'll be seeing 2 to 5% of max rate. You'll see capacity prices say 2 to 10% of max rate. In New England, you'll see them 30 to 60% of max rate. Mid-Atlantic, you'll see them anywhere between 25 and 70% of max rate. because that's also a constrained market. And then along the Gulf Coast, we're seeing now what used to be heavily discounted off-period prices come in at 60 and 70% of max rate because of the LNG export demand and the ability to segment capacity and pick up gas in Louisiana and move it to Texas and vice versa.
So could you benchmark what you expect the discount to be by looking at one of the capacity center like annual reports on a pipe?
Yeah, that's a very good indication. And when you become a new customer, we give you a year's worth of data for the pipes that you choose, and you have everything. You have the deals, the sellers, the buyers, the quantities, and the durations. So you know when the deal was done and the period that the deal covered. And so you can see, and also that data has the max rate. So it's all in a spreadsheet, and you just calculate what the deal rate was as a percentage of max rate. That tells you the discount.
Okay.
And like I said, you get that by becoming a customer, which we'll talk about in a moment. Next, please. So as we said before, there's a big reduction in the winter deals being solely for the period of the winter, meaning the 151 days. That is because they've been replaced by year-long deals and year-long quantities. And otherwise, the spread of deals of the different flavors and durations is about the same year over year. And the count of deals went down, but as I said before, the volume total of deals went up. So what's it going to take to find capacity this winter? There's several ways to find capacity. One, you can go on the bulletin board yourself, or with Capacity Center's core services, we monitor the bulletin boards 24/7, computer to computer. We get all the bids, all the capacity offers that are available for bid. So you don't have to look at every deal. You can get our service. It'll give you just the biddable deals, meaning the ones that are available to be bid on. Another way to use our service is if you subscribe to the service, on the pipelines you subscribe to, we'll give you last year's traded deals. So for instance, as in most markets, a good indicator of what's going to happen this year is what happened last year. So for instance, if you're interested in December or January capacity, you can get our service, find out who were the players that sold last year in December and January, and those are people who will likely be selling this year. So not only can you get the daily delivery of biddable deals in time to bid on them from our service, but you can do research and find out who are likely sellers because they were sellers last year. In addition to the biddable deals that we give you as part of our service, you know who traded the capacity. Every morning after yesterday's deals, every morning you're delivered on the pipelines you care about, all the deals that were done on that or those pipelines yesterday. Who bought, who sold, what was the price, what's the quantity, what are the points, what are the zones, what are the duration of the deals. That can tell you a lot about who your competitors are, as well as who your potential counterparties might be.
So maybe Greg, you could talk a little bit about, you do a lot of custom analytics and risk capacity work. Maybe you could get a little bit of what does that entail?
Yes. So one of the simplest things is if you get our service and request the following, an end of month report of all the trades your company has done on all the pipelines you trade on. That gives you information that can be used by your risk department to make sure all your deals reflect the same prices and quantities and periods that the pipeline's system of record reflects. And that's a risk report that you can get that will give you every deal that your company has done on the pipelines you've done it on. In addition, people often ask us for information about sort of reports for pipelines they might be looking to move on to or get deals going on, and get information about who are the players on those pipelines, who are the sellers, who are the buyers, what are the quantities, and how do those markets operate and go year to year. So that's another use of our service. Finally, if you're doing and you're hedging basis, one physical way to hedge basis is obviously acquire capacity. So understanding what capacity trades at and trades for and who are the players can help you lock down capacity to underpin your basis trades.
Thank you. Couple questions here that have come in. So amongst the new pipelines, will any have an impact this winter on capacity prices?
Not really. Most of the capacity that we've seen added has been southbound and Gulf Coast, and that'll run at very high load factors serving the LNG markets. The constraints are on the legacy pipelines, the existing pipelines. There's been hardly any expansions of note on the legacy pipelines to serve legacy markets. Most of the expansions have been on and to the Gulf Coast, and they'll run at high load factors. So we don't expect that those new pipelines will have any depressing or depressing effect on price or elevating effect on price of capacity, given that the capacity that's gone into service will be used by the shippers to serve those markets at high load factors.
Okay. So here's a question. Do you think LNG exports will have an impact on capacity prices?
As I basically said just a moment ago, during this winter, the LNG exports will remain very high. Southbound capacity, not very much of it, if any of it, will be in the market this winter. And the basis for capacity, the basis for gas between buy price and export will because that's very wide, the margins are very good. That will tend to increase the load factor of the LNG exporters, and any available capacity, existing capacity, not the built for them, but other capacity that could serve them, will be called upon by them. In the winter, a lot of LNG facilities can operate at somewhere between 104 and 108% capacity because the ambient temperature is lower and they can freeze more gas because of that. They can operate higher than nameplate load factors, which means they'll need more supply.
Okay. Next one that came in, let me read this. Will the increase in the Northeast of renewable power reduce the capacity needed for gas-fired plants significantly?
Could you say that again? Sorry, read the question again, please.
Yeah, basically because there's a lot of renewables being built in the Northeast, and one assumes that displacing some of the gas-fired generation, will that have an impact on capacity this coming winter?
No, I don't believe so, and here's why. Even well, at this point, for the next several years, increases in renewables will have hour by hour effects and not clock round effects. So, and the thing is, when you need capacity, you need to buy it for the whole day, even if you're only going to use it for several hours of peak when renewables are less. The renewable market in New England still needs to be supplemented, even on the low periods, by gas-fired generation and imports. So the swings will not be on the gas-fired. they'll be on the imports. The imports come in at basically gas prices. And so because the generators in New England are near the load pockets, they'll still be called upon to generate, and they'll need to generate when they'll need to have the capacity to generate when the intermittent renewables come off. And in New England, we have snow, we have cloud, which affects the solar. And even though we have a lot of wind, and that's in the morning, that's also when you have the peak demand for heating domestic and warming up the offices with electricity from the marginal gas-fired power plants.
Okay.
In years to come, when offshore wind becomes a significant factor, then we could very well see an impact on capacity prices as we get 400 and 500 megawatts of wind power. But today, it's not significant enough to affect demand for gas capacity.
Okay.
One last thought I'd like to leave with you. If you have people staring at bulletin boards to see if capacity is available, or making bunches of phone calls that don't get responded to, trying to find capacity, Capacity Center can give you information that narrows your search and, as I said, can give you deals that are ready to be biddable, ready to be bid upon in time to bid, and save your people time and money from looking at bulletin boards that either don't change or not knowing which bulletin boards to look at. We can give you the information you need to trade capacity without your people having to spend time on bulletin boards looking for what might not be there to find.
All right. Well, thank you, Greg. For those that we didn't have time to answer questions, they've been captured on the system. So either Greg or I will respond to that by email within a day or two. So thanks again for watching. Have a great day.
Thank you all.